Alright, in this video we'll talk about the last two steps of the 5-step revenue recognition process. Beginning with step 4, allocate the transaction price to the separate performance obligations. So this occurs when you have more than one performance obligation in your contract. The general rule is you allocate it based on the relative fair values of the performance obligations. And the fair value is what each performance obligation would sell for if sold separately. Okay, so pretty easy. Standard accounting treatment the FASB has chosen here. Very similar to buying a lump sum of inventory and allocating the values based on the standalone fair values. Or issuing two securities like common stock with preferred stock or common stock with a bond. Very similar treatment, proportional method. Now, if the fair value of one or more performance obligations is unknown, then in these situations you have to use some alternative methods. And we're going to talk about 3 methods and how we would do them. We have the adjusted market assessment approach. These are in order of desirability. So this is the best thing you could do if you didn't know the fair value. The second approach is the expected cost plus margin approach. And the third approach is the residual approach. So in the adjusted market assessment approach, you estimate the price customers would pay for the goods or services. And this involves just referring to prices from competitors for similar goods or services. So as you can imagine, that is the best thing you could do. The FASB considers it the best thing you could do if you don't know the fair value of one or more of your performance obligations. Simply refer to the price of competitors charging for it. The next best thing you could do is an expected cost plus margin approach. So here you would forecast the expected cost of satisfying the performance obligation and add on an appropriate margin and say that that is the fair value of that performance obligation. Then there's the residual approach. And so let me move the screen there. Hold on, just trying to figure out this software. Okay, I think I figured it out. Okay, so the residual approach, if the standalone price of a good or service is highly variable or uncertain, then what you can do is estimate the standalone price by referencing the total transaction price less the sum of the observable standalone selling prices of the other goods or services in the contract. Long way of saying the incremental approach, if you remember from when we talked about issuing two securities at once, and you only know the fair value of one of them. Incremental approach, essentially. But again, these are order of desirability, and all of them are inferior to the best way, which is if you know the fair value of both, using the proportional method there. Anyhow, step 5, we recognize the revenue as each performance obligation is satisfied. And we generally say that the seller satisfies its performance obligation when the customer obtains control of the good or service. Here are some signs that the customer has gained control. One is that they have a right to payment for the asset. The seller has the right to it. The seller has transferred legal title of the asset. The seller has transferred physical possession of the asset. The customer now has the significant risks and rewards of ownership. This is why giving someone goods on consignment is not a sale, because if they cannot sell them, they can give them back to you. So they are not bearing the risks of ownership there. The customer has accepted the asset. Those are all signs that the customer has gained control. A special case here we want to talk about is sales with the right of return. Let's have an example. Weasley sells 100 products for $100 each to Grainger Incorporated, and Weasley allows customers to return unused product within 30 days and get a full refund. Each product costs $60. Weasley uses the most likely amount method to estimate how much product will be returned. Using this method, Weasley estimates that 3 products are going to be returned, Weasley believes. The costs of recovering these products, in other words, the return shipping and things like that, restocking, will be immaterial. And the return products will later be resold as normal for a profit. So how is Weasley to account for the initial sale of these 100 products when they believe that 3 will be returned? Well, here is what we'll do. Okay, so how much revenue should Weasley get to recognize? If you answered at $9,700, you'd be correct. We're only going to recognize revenue on 97 units. Okay, and then we're gonna credit this account refund liability. As you may have guessed, refund liability is a liability. Okay, and it will go away when you refund Grainger, assuming Weasley's correct that 3 will be returned. And also when you have the sale, of course, you have cost of goods sold and you credit inventory. But what's interesting is you don't debit the cost of goods sold for the full 100 units because you're assuming that 3 will be returned. So you now have this item on your asset side of your balance sheet here, $60 times 3 is $180, estimated inventory returns. So this is a new account here. And that goes with your inventory account. It doesn't all go together. It is separated on the balance sheet, often in the notes of the financials. So then later, let's say Grainger returns 2 units because, you know, companies are never 100% correct with their forecasts. So if that's the case, the refund liability account will go down for 2 units worth. Accounts payable will go up because we now have to pay Grainger. The return inventory account goes up and estimated inventory returns goes down. So this estimated inventory returns is really a temporary account. It goes away now, and you now have returned inventory, which is separate from your inventory account. Well, they're both assets. They're both short-term assets, current assets. Okay. Another special situation is repurchase agreements. This is a situation where one firm transfers an asset to a customer but has an obligation or a right to repurchase the asset at a later date. These are not sales. These used to be situations where 2 companies would try to help a company out in a way of helping that company meet a revenue target or an earnings target by making a sale without having to actually make a sale. They said, well, I'll sell you something and I agree to rebuy it the next year. Not a sale. The FASB has cracked down on that. So let's say Tony sells equipment to Poly on January 1st, 2016 for $200K. However, Tony agrees to repurchase the equipment from Poly on December 31st, 2017. Okay, so 2 years later at a price of $242,000. So on the date of this initial transaction, there will be no sales revenue. This is important. This is not a sale. Tony gets cash. But at the same time, he now has a liability to Poly Company. You know, you can call it whatever you may want, some kind of payable here, but this is the idea. And then at the end of the year, the first year, we're going to assume a 10% imputed interest rate, and you'll see why that is later. But, you know, essentially, you have an interest expense and an additional liability to Poly Company. All right. And then on the repurchase date, you're going to accrue 10% more interest here on the new principal. The principal was 200 plus 20. Now it's 220. So you're going to have interest expense of 220 times 10% is 22,000. So if you look at a T account, if you're sitting there with a piece of paper, notice that the liability to Poly Company is now 242,000. And so that's why we imputed a 10% interest rate, because it works out that way mathematically. If you lend this equipment to him for 2 years, this is really the interest on it. And of course, we now have to pay Poly back. So our liability on that day will go down, and we are paying $242,000 of cash. No sales revenue anywhere throughout. even though both companies said they were making a sale. The FASB says no. Bill and hold arrangements, another special situation where customers take title of the asset, but the seller maintains the physical possession. So very dangerous area for earnings management, right? You're auditing a company, you go in their warehouse, and they tell you that all this stuff over here has been sold. And you're like, well, why is it still here? Kind of fishy, right? The FASB says you can recognize revenue, but you got to pass like the test. A lot of requirements need to be met. Let's say Harper sells $300K of basketball equipment, cost $180, to Pippin. Harper agrees to retain the equipment in his warehouse until Pippin's new gym opens up. Title passes to Pippin at the time the agreement is signed. When should Harper be able to recognize the revenue from this sale? Because this is a bill and hold here. Well, here's the deal. It depends. Harper has to decide when Pippin has gained control of the product, and all four of these conditions have to be met if Harper wants to recognize revenue from this sale. There must be a very good reason for the bill and hold arrangement. That's the first thing. In this case, Pippin's gym is not yet open, so that's a decent arrangement. They're still working on it. The product must be identified separately as belonging to Pippin. So if you have thousands upon thousands of pieces of gym equipment in your warehouse as Harper, you can't tell the auditor that some of this is Pippin's. It doesn't matter which. They're all the same models. No, you have to designate this certain space. These are Pippin's. Number 3, the product must be ready for physical transfer to Pippin. So you can't have, pipes and nuts and bolts lying around and say like, yeah, this is Pippin's. He's not ready for it, so it's okay that we haven't put it together yet. No, it has to be ready for transfer. And number 4, Harper cannot have the ability to use the product or direct it to another customer. So we can't say that these are Pippin's unless someone else comes along and offers me more money. No. If all those are met, you get to recognize revenue. Principal-agent relationships. Say Priceline is an agent for United Airlines. Priceline collects money from customers when they book their tickets and remits it to United Airlines less a commission. The general rule, guys, is that amounts collected on behalf of the principal are not the revenue of the agent. The revenue for the agent is the amount of commission it receives, which makes sense, right? I mean, you book a flight for someone, you don't get to keep like the whole revenue from the whole ticket. You get that little piece of it, your commission. Consignments. Okay, so manufacturers or wholesalers deliver goods but retain title of the goods until they are sold. This is a very common arrangement. Steinmart, places like that, you have consignment sales, and the wholesalers deliver the goods there, and they sit in the warehouse until they're sold. So they are the consignors. The consignees are the Steinmarts of the world. And the consignor makes a profit on the sale, and the consignee makes a commission. But the point is, when that wholesaler drops off the goods at Steinmart, they have not made any sale yet at that point. They can't report any sale. And this is a good place to stop for now.